So, Nate, we were talking about mortgage rates a little bit ago and how we keep repeating how historically low they are. But there's also debate and topic discussion, especially with the release from Freddie Mac this week, that rates potentially could rise later in 2012 and 2013, including like right now our average I think it hit below 4 down to like the 3.9s. People saying predictions of 4.5% by the end of 2012 and 5.4% in 2013. So it could swing a point to a point and a half, in a relatively reasonable time frame. What would you tell people that are out there thinking about either refinancing now or buying now at the risk of, literally, if their rate goes from 3.9 to 5.4, you're looking at about a 40% increase, 45% increase in your payment pretty quickly.
Right. If you're looking at real estate values and you're trying to time the market, which no one would ever recommend that you do, if you're paying cash, that's one thing. But most people are not paying cash. They're buying a home, they're getting financing.
You got to measure that.
You got to measure that. So, for example, let's say your price drops on a home that you delayed buying and it dropped by 10 grand, but yet your interest rate went up over 1% or even just 1%.
You lost money.
You actually lost money. Now, if you had the ability to pay cash, then that's a different scenario, but most people don't. They're getting loans. So, at the end of the day, it comes to this. How much is your down payment plus what are your monthly payments times the number of payments? That's how much you're really paying for that house. So if the rates go up and yet the prices drop, you can actually end up being putting yourself in a more expensive position.
A lot of people and a lot of home buyers really don't take this into consideration. They look at price. I've got a negotiation going on right now that's literally a couple $1,000s apart. And like the fluctuation in mortgage-backed securities could cause them to lose more than a couple grand they think they're saving in this negotiation. If interest rates bump up, like a lot of people predict that they will, you just lost money. By thinking you're saving on price, you lost money on term.
Oh, the rates are just as important as the price. Some people consider the rates as an afterthought.
It's more important.
Yeah,
it's more important.
Possibly more. Yeah, I would agree. And as far as the refinancing, folks, if you're at a point where you can save money, and it makes sense to do it. And there's analysis that we run our borrowers through to basically do a cost benefit and see whenever it's going to be a break even point for them on a refinance is. I would say waiting is risky. In my opinion, the potential for an increase in rate is substantially greater than that of a decrease in rate. You're getting to a point where, even though the market may support a lower rate, maybe it's a quarter, maybe it's a half, you got to understand there's inherent costs involved with people collecting mortgage payments. So even though the market would say it would warrant a lower interest rate, you get to a point where, like I said, people they have to pay for the servicers, they have to pay for your phone calls, they have to know you got payments, and you're going to get a bottom. And it's just going to say, you know what, it's just not even worth investing money in these things anymore because the return is so low, we'd be better off buying a treasury, and there's no worries, no defaults, no insurance, no property taxes, etc. And I think you're very close to that.
Yeah, and I think we're going to continue this discussion about mortgage interest rates and the mortgage market after a quick break here on the Duncan Duo Real Estate Show.